some intuition shit. I'm not trying to teach y'all Enigma because the Enigma does not exist. I'm trying to teach y'all my methodologies, but in a much more simplified way. Because of course I cannot talk about overall. I cannot talk about specifics because I don't want you guys to know my model. And that's all right. You don't need to learn my model, but you need to know why the real markets work, how they freaking work, and how you pretty much anticipate price, not from an intuition perspective, not from a freaking guru perspective, not from an ICT perspective, but from your own perspective and from a probabilistical standpoint. That's literally what I'm trying to do here. I'm not trying to like tell you to do something. I'm trying to teach you all to do something, alright? And to learn it yourself and to learn it from yourself and to not listen to anybody else other than yourself, again, because that's how you become profitable. Now, I've talked about so much here and there about the strengthening dollar now recently. Hopefully everybody have watched my recent calls, but none of you guys actually understand why specifically I'm looking for a strengthening in the dollar. Now, I'm gonna cover it. So, everybody, I don't know how up to date y'all with economic events. I don't know how much you are into a central bank perspective. I don't know how much you are into those sort of things. And guess what? You don't need to be in those things, alright? But I'm explaining from my perspective. I'm explaining from my experience, and from my experience this is how I trade, alright? And so this is the real truth. This is how I look at the markets. This is how I do things. This is how I perform in the markets, and this is how I become profitable in the markets. It's not from freaking structural ICT, alright? Like all people believe. Because what people believe is literally I calculate things on small fair value gaps or whatever in the markets. I could care less. I don't even use that anymore. I don't use ICT concepts, if I'm honest, that much anymore. And I'm not use that, but I use that for me to explain the things I'm doing in the markets, so you guys understand what I'm doing in the markets. Like I said, it's like a language, alright? You need to understand it for you to understand specifically what I'm looking for, because otherwise all the shit would just be words without context. But you understand the context, I understand then what it means, I understand overall then what I'm looking for. Now, from a central bank perspective, alright, what they're specifically looking for, I don't know how much you are up to my Twitter or anything like that, but you should possibly check that out after this. Now, what I've talked about and what the Federal Reserve, Jay Powell, have talked about is at least that he monitoring unemployment and he monitoring this CPI, aka core inflation, very specifically. Now, I'm not going to talk about why he's doing that, alright? That's specific. I'm not going to go into specifics why he's looking at specifically those two and not the non-farm payroll and not the PPE or anything like that, PPI or GDP or anything like that. Why he's not looking at those specific economic numbers and why he's specifically focusing on CPI and unemployment. And for the simple reason why he's focusing on those specifically is because he's focusing on if the economy is pretty much contracting or if it's expanding, alright? He's trying to figure out that. And he's trying to figure out to what extent the economy is declining and to what extent the economy is declining, right? And of course, if you're seeing an expansion, you're seeing increased inflation, alright? Inflation just means more money in overall circulation, more people spending money fast. It's the velocity of money. So in increasing velocity of the money, I don't know how much you are into that theory, but that's something you potentially should check out. I'm sorry for this yap, but it's just a little bit of an introduction to understanding why specifically I'm looking for a higher dollar, right? Because, I'm focusing on the whole markets, but you can use the dollar for literally predicting each and everything, but also the things I provide in this context. Now, velocity of the money more or less implies that the more money changes hand, the higher the inflation is going to be, etc., etc., right? I think, and that of course implies that expanding the market is or the economy is expanding, right? Now, the central bankers, from a central bank perspective, what they're trying to do is keep overall the nominal inflation, the annual inflation rate at 2%. Alright, the target is at 2%. I don't know. That's why specifically they're looking at the CPI. They wanted to go down to 2% and they wanted to stay at 2%. Now, unemployment on the other hand, they're looking at the decline and they're monitoring that to possibly see an increase in unemployment, which would then imply a decrease in economic growth, right? Which then would be changed. Like they're trying to keep it stable. And so how are they trying to keep it stable, right? The central bankers works from overall the main overall tool to make changes in the economy to try to keep the economy stable is through monetary policy. And of course, monetary policy is raising the rates or lowering the rates. Now, the rates here is something you need to understand has a freaking crazy correlation to currency, alright? If the rates is high, I don't know why you guys are not looking at these things. Like, what are you guys doing? If you're not into rates, you should not be trading currencies. You should not be trading FX. Now, this is different if you're if you're trading NASDAQ or whatever, but this is something no one even talks about in FX space. No one even talks about rates. No one even talks about interest rates, which is crazy. Like, it's the most basic ass shit. It's something everybody should understand, interest rates, because currency follows interest rates just that closely. Now, interest rates is freaking crazy high compared to all other countries, alright? The US interest rates is crazy freaking extremely high compared to the ECB set interest rates for the Eurozone, alright? And the Eurozone's interest rates is freaking crazy low. And so, what does that bring? Well, that brings a freaking imbalance between the currency and the rate. Because what should a currency do in theory? Well, it should be the strong. If the US interest rates is the strongest interest rates in the world currently, shouldn't the currency then, in theory, be the strongest currency in the world? Well, at the moment, it is actually not. Alright, it is in theory. It is of course all still the world's reserve currency, etc., etc. But in price, in structure, it is not. And so there you have a real freaking imbalance between currency and rate, which is the thing I'm trading. That's the thing I'm trading. Now, this first underlying dynamic, that's what I call the set interest rates. Listen how much freaking sauce I'm giving you guys in this call. Like, if you're not appreciating this, I don't know, leave, alright, please. I'm gonna ban you then. No, I'm just joking. But for real, this is things you need to listen up to, because this is basic ass shit, and this is basic ass economics you should have learned, alright? If you're not learning this and you're trading, you should potentially consider quitting trading, because you have been fooled. You have been fooled by ICT, you have been fooled by me, you have been fooled by everybody in this industry. And this is a wake-up call for you guys to actually put put yourself into motion and actually researching things, search things. You have freaking Google, guys. Read books, alright? Do whatever, right? But yeah, like, focus on your own freaking perspective. Don't focus on what ICT is saying. Don't focus on what your fucking TikTok says, bro. You should focus on what yourself. You should research this yourself. You should focus on the driving force of the markets, alright? And so, first dynamics, in a simple manner, right, gets very closely reflected on yields. And what is yields? Well, yields is of course the rates on bonds. Now, I'm not going to go into specifics on bonds. I'm not going to go into specifics on yields. But you can see this just reflected on the yields here. Alright? And the yields has an even closer correlation to currencies. That's just all you need to have here. That's just all you need to have here. Alright? That's just all you freaking need to have. And I think the correlation goes up to potentially 70%, 80% of a close correlation, which is crazy if you think about it. And so here you have probabilities, right? Because there's an 80% likelihood then, if the correlation is 80%. You should collect data on this. You should collect data on how closely currencies follows other things, right? Look at correlations, look at intermarket connections, etc., etc., and indirect correlations and direct correlations. I'm not going into specifics about indirect correlations and direct correlations. You'll have to figure it out yourselves. But yet again, we should see an 80%. There's like now an 80% chance of seeing a higher dollar, because we have seen the yields go up higher. I'm not going to specifically talk about how I noticed that, when I noticed that, how I use it, what specific things I use on the yields, but I use future projections, etc., etc. And I'm not going to go into specifics about future projections, advanced prime projections, or real imbalances. Those are specific things, and so I'm not going to talk about it. But now you have the context behind why I want to see a crazy freaking high dollar, alright? Now let's see if you guys have any questions about these things so far. So you guys have any questions, by the way, about this so far? Or is it so far so good? Everybody understands the context behind it and the specifics behind it? All good? That's perfect, bro. That's perfect. And if you don't understand these things yet, alright, don't worry about it. You have freaking years to learn this shit, alright? Because now I've set you guys on the right path to freaking learn the real markets. not just ICT perspective, but from your own perspective. This is how I developed as a trader, and I think this is how a real trader develops. All right, they're not looking at other people; they're looking at themselves. So we're gonna see if we have two people. Of course, I'm potentially. No. This is not recorded. All right, this is too specific. This is too detailed. I'm never gonna get out. Like, this is crazy. Your people here are the only people hearing this. All right. I promise you guys doing these in-depth calls, but it's only for the server. It's only for the people listening in. All right. It's not for anybody else. If I were to talk about this, it would be crazy. All right. So this is for you to pretty much specifically focus in on. So research this. Is it? So I'm just gonna ask it like, is it? All right. This is just for you. So you get to research it. I don't go into it. All right. I don't answer that specific question. But for me, the yields and the dollar has an 80% close correlation. All right. And I've got it up because you need to gather data. All right. For real. You need to trade probabilities, not just intuition. You can trade intuition to an extent, but I would never trade it fully. All right, I need to understand context. I need to understand why things is happening in markets, and I need also to understand why things is failing. And sometimes it's for the simple reasons that you're on the wrong side of the probability. So if you have anything which has happened 80% in the time, 80% of the time in the markets, you have an 80% chance of an occurrence rate. I'm not gonna talk about how I calculate occurrence rates or anything like that, but you have something which overall shows up 80% of the time in the markets, right? You calculated that, you have done that, you have fixed that, right? Now, if that fails once, twice, three times in a row, well, you were just on the wrong side of the probabilities, because you know if if you're doing this 1,000 times, you know that 80% of those 1,000 times is gonna be wrong, and you know that 20%, I'm just sorry, you know that 20% of the time you're gonna be wrong, and 80% of the time, if you're collecting that, let's say if you're taking that trade 800 times, right, you're gonna be 80% of the time right, and you're gonna be 20% wrong, right, 20% of the time, and there's nothing to do about it. It's just your model. No one has a freaking 100% win rate. All right, it's impossible in these markets, because these markets are random, but they are random to an extent. All right, meaning they're still tradable, but they're still random. All right, that's something you need to understand. Now, overall, we were looking for a strengthening dollar, and we were looking for a strengthening dollar from here, from this perspective. Now, like I've talked about, I have a structural way of reading the market, but I have also an external way of reading the markets. And from an external way, the external way starting more or less from when we took out the sell side liquidity down in here, which is not random at all, because of course the external way and contextual structural way of looking at the markets goes hand in hand, and when they're not going hand in hand, listen up, you usually see a consolidation. So if you learn the things which I've talked about now, and you specifically focus in on those things, you're gonna learn that, well, when those things are not aligning, you're not gonna see high probability setups, and you're usually gonna see a consolidation, which is why we saw consolidation a little bit here, but then we saw clean price action. But like we saw major time-based liquidity getting taken out right here, major liquidity, engineer liquidity getting taken out here. And of course, we saw externals overall pointing up towards a higher dollar, right? And so we were focusing on a low, we were also focusing on a specific price level, and then we were focusing in on just specific high prices. Now, I'm not going to talk about why I specifically took this drawn liquidity, but I'm just going to mention that, well, this drawn liquidity for me looks very good, because we have mass engineer liquidity over there, and on a higher time frame perspective, I'm looking for over a lower rate, because I am not hawkish on the rates. All right, I'm actually dovish on the rates. All right, I want to see lower rates. I want to see the central bank putting out lower rates, because I'm not going to talk about specifics, but yes, I'm thinking we are in the 4th or 5th stage in the business cycles, meaning I'm looking for an overall decline in the rates, meaning I'm bearish on the dollar on a long-term perspective externally, but also structurally. All right, so when the structural and external way aligns up, you're gonna find pretty much where the market is gonna reverse, etc., etc. Very simple, very simple, and of course very contextual as well. But as we can see here on the 4-hour time frame, right, the specific things we are to look for is of course just a strengthening dollar on a higher time frame perspective, but also on an immediate term perspective, because how I read it on an intermediate and short-term perspective is that look at liquidity and look at where liquidity is resting. Now, personally, we're going to talk specifics about where I think the market is going to be heading for the next couple of weeks and where I think it's going to heading towards the short-term perspective. But why I talk about these contextual things, why I talk about the externals, etc., even though I should not, but I wanted to make this very special call for you, the specific people joining in. And that's just to provide you context with why I have a bullish bias on the dollar, right? That why I want to see a higher dollar. Now, of course, from a structural way of looking at it, as we know, externals are bullish, and so we are just looking for simple sweeps for a higher probability setup later up towards the upside, right? So the more liquidity towards the downside we sweep now, the higher the probabilities of seeing an upswing will happen, because at the lows here, as we know, the rates are high. It's good to invest in the dollar. It more or less it's more or less has a higher probability now of seeing 80% actually of seeing an increase in price. So if we see a decrease in price, we have an even higher probability chance of seeing an increase in price later, which is exactly my methodologies. Now, this is potentially even shorter shit, alright, I'm talking about. But yet again, then that provides me a contextual side of seeing potential upside after seeing extensive liquidity getting swept. Now, there's a few ways of looking at liquidity, etc., but of course, I'm looking at specific engineered liquidity, right? Now, that's pretty much what I'm looking for. So for next week, guys, a short term, a simple manner, I'm looking at, as we are externally bullish, I know we have an 80% chance of pretty much reaching up higher because we need to fill that real imbalance. The lower we go, the higher probability of an higher price we'll have, alright? So the lower we go here, I could care less if we see this or if we see this, but I have not gathered any levels or anything like that. I'm gonna do that next week. But if we see something, at least lower prices in the beginning of the week, it would be much better, or it would be much higher probability of seeing higher probability setups later down the week when we see a possibility for, you know, and high possibility and high probability of seeing then higher prices, because the longer price stays this low, the higher the probabilities will increase for price to reprice the imbalance later. Hopefully this all makes sense, alright? I know it's a little bit in-depth now. It should be in-depth, alright? You're gonna learn this because I'm gonna have 2 of these calls every week. So, like, it's gonna take you a little bit of time to understand this little bit more complex thing, way of looking at the markets. But it's not really complex when you understand it, because this is how you really should look at the markets. Like, this is the real way of looking at the markets from my perspective. Now, yeah, everybody should develop their own perspective, like I talked about. Now, that's exactly what I'm looking for specifically now. So I'm looking for overall simple decline in the dollar, taking out engineer liquidity. And since we overall are bullish, I'm looking for higher prices later. Simple reason. And I'm looking for that up to the drawn liquidity. Simple as that. Simple as that. Now, I would personally also want us to engineer some buy-side liquidity here for next week. So I would want us to potentially on Monday, like I said, want to see us form engineer equal highs or whatever, just form more engineer liquidity. So not just this left behind. I want to see much more engineer liquidity up here. I want to see us pretty much deliver down lower and take out engineer sell-side liquidity, and then see an upswing towards the upside. That's exactly what I'm looking for next week. So you see the engineer liquidity down here, which is formed right here. I'm just gonna zoom into it. You see right here, equal lows, perfect equal lows as well, perfect equal lows. So I'm looking for this engineer liquidity here specifically, but also potentially this engineered trendline liquidity up here, and potentially as low as this right there for next week, as low as this potentially for next week, which would then be a weekly STA, as that's time-based liquidity. But also this, by the way, this is also time-based liquidity. So this is the specific things I'm looking for. Now let's just go to EURUSD. Let's just talk a little bit about it. Now, the same thing applies as we're looking for a strengthening dollar here. We're looking for a major strength in the dollar, like short term, right? And I'm gonna also talk potentially a little bit how you confirm your theory about these. So if you have developed the theory, how you confirm the theory, and how you get a higher probability theory into the markets. And I'm gonna talk about that's exactly what the COT does for me. So if I have a theory about the markets, I have a theory about hedging in the markets going on by the central banks, or pretty much central banks holding. I don't know if you remember, but we talked about the central banks pretty much holding the euro up here. We talked about them more or less doing it to hedge against potential lower euro prices short term. And that's exactly pretty much We confirmed our theory by using COT and using change in orders, right? And that's something pretty much, and that's exactly how I confirm my theories about what we're gonna see in the markets. So that's how I confirm my pre-established beliefs about the real imbalances which I'm trading. Now overall, what you can see right here is just more or less that we have been in this big ass consolidation right here, and so you can see we have formed a lot of engineered buy side liquidity up here, but also a lot of engineered sell side liquidity. So for us overall, we need to see a similar move as the DXY. So we want to see a strengthening in the euro before weakening in the euro. And that's for the simple reason that if we trade up higher for the euro prior to going lower, we're going to see a higher probability of seeing lower prices later, if that makes sense. So it's exactly the same thing as I explained with a weakening dollar for a strengthening dollar. And a higher euro here would pretty much provide us with a higher probability of seeing that imbalance fill, because if you think about it, the real imbalance, I'm not supposed to talk about this, but the real imbalance goes through all the way here. All right, this is the real imbalance. Now the real imbalance is going to shrink on one side. All right, it's going to go lower on one side because you're going to see lowering yields, and you're going to see potential lowering rates, but the imbalance is still going to persist, and the market always needs to find an equilibrium, right? Now, if we are going away from the imbalance, right, which the price here is imbalanced, well, the inefficiency, right, the real inefficiency is increasing, and if the real inefficiency is increasing, doesn't that provide you, or isn't that a higher probability as the inefficiency needs to, on an 80% basis, need to get filled? It's moving you closer towards the real imbalance, because the real imbalance is moving with you. So the higher you go, the bigger imbalance needs to get filled, and the overall more the probabilities pretty much increases therefore, because you're pretty much staying away from the filling the imbalance for longer, because you only have a certain time to fill this. So hopefully that's understandable. Any questions so far, by the way? Yeah, bro, I should not talk so much about this, bro. I'm giving too much sauce, but I think majority of the people don't understand shit what I'm talking about. But I think it's good. I think it's still good. They're learning. Yeah, a very good question here about big news. So could big news change this? So overall, let's say, could let's say PPI change the direction of EURUSD now? Well, if you understand what we're specifically looking for, and understand what the central banks is specifically looking for, like I've mentioned in the beginning, alright? I've talked about more or less that they're more focused on CPI, and that they're more focused on unemployment, right? Now, what's interesting here, alright, is that this is all already priced into the markets. So the news you're referring to that possibly could change the markets can't change the market. It can't, because it's already in the markets, if that makes sense. It's already priced in, the yields has already priced in, the rates moves 6 months before the markets. So it's already priced in. It won't change. Like, even if the CPI drops aggressively, alright, it won't price in, because it's already priced into the price, if that makes sense. Like, the CPI is what made the yields move in the first place. The CPI's place, the news place, is what made the CPI move, or is what made the yields move, which then yields move the markets, if you understand. So the news can change the direction of the markets, but overall the news can price in new data, which we get, which then can change the direction of the markets. So we're always forward looking, and the markets is always forward looking. And overall, what you need to understand is that they cannot specifically change the direction of the markets if you're pricing in the right direction of the markets beforehand. And you're pricing in the right direction of the markets beforehand because you're looking at the externals, and the externals has already priced in that beforehand. So the news, this is like why pretty much we saw the big drop in the euro. It's not random. And of course, all of this is just to a certain extent. So you also have to remember that this is just overall in a probabilistical manner. I could be wrong, but I'm always trying to talk about what's highest probability in terms of a data-driven thing. Alright? So I'm always talking about correlations, which is in a probabilistical manner higher probability of continuing correlation than decoupling and not continuing a correlation, and vice versa. And the same thing goes for rates. It's all to an extent, but you also have to remember that it can, in some small cases, in news events, in black swan events, change. But only in very, very rare cases, because we're trading probabilities. We're not trading like we're trading with the probabilities. We're not trading against the probabilities. So of course you can think of, oh, this news is going to change it, but you never know, because we're only looking at probabilities and we're only looking at what's most probable to happen. And of course that's how we become profitable, because if you're not trading with probabilities, you're going to have an equity curve which declines instead of increases, and we're trying to get an equity curve which increases, right? And with how you get an equity curve which increases is with trading what's most probable, like trading with the probabilities instead of against the probabilities. If that makes sense, I don't know. Hopefully it makes sense. That's like how I think of it. I think about it. So I'm just keeping with a trend overall, but I'm trying to pre-plan of what's actually happening. So as you can see right here, we are just to continue down lower personally. So I think we're gonna go reach for this strong liquidity. And after that, we're going to see an increase in the euro price. But after, we need to just fill this imbalance right here. And personally, why I want to see an increase is because we're going to see a higher probability setup. If so, otherwise, I'll not take any setups. And that's an STA, because I'm just keeping with the probabilities here. Now, of course, I'm going to also... that's why specifically we're talking about sweeps, etc., etc. It's just because of the liquidity. And you can see the engineer liquidity right here. So like it's pretty obvious, the engineer liquidity right here. I want to see this engineer liquidity getting taken out for me to then more or less be aggressive and take a short on the euro, if that makes sense. And of course this would be time-based liquidity. And my motto, like now you understand my motto. My motto is just external alignment and time-based liquidity sweep. That's all I've said always. And that's literally my motto. That's all I trade, as you can see here. As you can see here. So we got to talk about it. Now let's go in through the individual trades, because now you know specifically what I'm looking for next week, etc., etc. And you know the context behind it. You know why, and I'm gonna update y'all, because pretty much you can just you know, you're gonna get updates because you're gonna have 2 calls every week. So let's go into the 50-minute time frame right here. And let's just go through the 2 different trades here, and then let's just focus on some data. All right. Because I think everybody have had enough about my yap. But as you can see right here, as I was aggressively seeking lower euro prices due to the context I've previously provided, I was looking for an decrease, an aggressive decrease due to aggressive hedging, etc., etc., going on in the euro. And so I was looking for extensive liquidity getting taken out, and so I saw extensive liquidity getting taken out here, as you can see right here. So extensive liquidity getting taken out, engineer liquidity, but I also saw specific time-based liquidity getting taken out right here. And this was time-based liquidity because it was the longer range, and so I was pretty much focusing on the first displacement on the 5-minute time frame. After that, I was just taking and short from a specific fair value gap or premium or whatever in a specific area, but ended up actually being a loss in this case, as you can see here. And my terminus got actually taken here, and terminus is another thing for just calling it protected high. So my protected high got taken right here, which overall failed the trade, so it was a loss. Now moving on, overall my high was taken out, moved up higher. We more or less took out more engineer liquidity here. Notice the probabilities increase here, as you can see. The probabilities of seeing a lower euro now increased for me. So what did I look for? Well, I looked for a displacement, as we saw here. This was also more or less mediocre STL person, I would say. Not a good one, but this was something me and the students were pricing in. And after that, more or less, we moved on to the Thursday here. And as we have seen, extensive liquidity got taken out right here. In terms of engineer liquidity, time-based liquidity, you get the idea. We were looking for a real high probability scale in. And so... you know, you get the idea, you get the context. I'm not going to repeat myself. So we just waited for engineer liquidity here to get taken out. And so that's exactly what we saw. And we just enter this right here. And more or less focused on sell side liquidity here. and that's exactly pretty much what we were focusing on. Now my full take profit did not hit, but on some accounts I pretty much scaled out, and on some accounts I was stopped out, think down in here somewhere, down right there. So not full one, but this was my first initial sell, and my second scaling was this right here, this right there, this right here. That was my second scaling. And you can see the executions posted in transparency. Alright, so you can go to that channel. I just changed the name. Okay. I think it sounds better over now when we have this 2.0 thing, and I want to go through some more in-depth stuff with y'all. And then today we saw a real big move to the downside. Now, I think this big move to the downside just increases the probability if we go up here of seeing an crazy ass sell. So hopefully we form a low here, somewhere here, and we're also just increasing price Monday, Tuesday, and we're gonna see pretty much a power 3, what ICT would call power 3 to the downside. Hopefully that would make sense for everybody here. Yeah, do you have any questions, by the way, about this so far? Or is it so far so good? Shall I move on? Can we find entry with Algolock? Oh, I'm not gonna talk about this here. But yes, I use Algolock in yes here. That's correct. But I cannot talk about it here. I'm super sorry. That would be too in-depth for me, alright? Yes, 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 I can look at the NQ and gold, so don't worry about it. Now, I don't know if you have looked at, I think I've posted, I'll just pretty much go to my X here and see if I've actually posted something, because I think I have, otherwise I've messed up big time, but I think I have posted. And I think it just provide you a little bit more context here. No, I'm super sorry, I think I have not posted the update. Alright, very sad. Anyways, I'll just pretty much give you some hints of what I'm looking for. So, if you overall go to looking at dark pools, etc., etc., look at orders, right? My theory is, of course, that we're gonna see that we still have, in a contextual way, we have extremely high rates. We have extremely high rates, which overall, you know, in this optimism, in terms of higher NQ, right, and higher NASDAQ. I think it's too much of an optimism in NASDAQ right now, and I think it's too bullish per se. Now, I'm not bearish on NASDAQ like I've talked about. I think I've talked about it as I think. So I'm not really bearish, alright, on NASDAQ per se long term, but I'm bearish short term now. And I am more or less not extremely bearish short term, but I am at least bearish. I'm watching a decline. And so, when do you think this decline is going to start? Well, I think personally it's going to start this next week, alright? And why I'm specifically looking for this decline is just because you can see the retailers has actually started scaling in now, and it's more or less when retailers scaling. How can you watch retailers scaling? Well, you can go into dark pools and you can see inverse dark pools and you can see retail flows. And if you watch the retail flows, you can see retail flows has increased tremendously right now. Now, in a structural manner, you can see we have left a gap right here, right there, everybody. And we also have time-based liquidity, south-side liquidity resting right here. And we also have engineer liquidity right here. So personally, from a market structure way, it would be much better, as pointed out here. We also have FVG right here. We have an FVG. And we also have a lot of other concepts right here, but most notably in high resistance liquidity zone. So something I'm watching. I don't necessarily watch specific fair value gaps or whatever, but I'm just watching this specific area, and specifically these nearest lows right here. So these nearest lows right here, order block, supply and demand, whatever you want to call it, support and resistance. You see the level right here. We have failed to breach that at least. And so for me, as retail flows increase right here, I'm watching overall and high getting formed, and I'm watching overall us pretty much decreasing in price for us to then reach up higher, because I think we need to fill this void right here as well, this gap. I think we need to fill this gap and take out the south side liquidity down in here for us to be rebalanced from a structural manner, like looking at just liquidity. We have high liquidity resistance zone, bam, hard way for price to take out. We have smart money, selling up here. We have dumb money buying up here. We have large sell side liquidity resting. And so from a structure manner, and data driven manner, usually, and from a confirmational manner, looking at the retail flows and looking at smart money, it's telling me that we're approaching the high here and that we are overall gonna trade down lower for us to reprice, take out liquidity, and then trade to new all-time highs. So that's my analysis on NASDAQ. Dark pools word of the week. For real, bro. Dark pools is the go to shit, bro. Small money is how you follow small money on NASDAQ. Not gonna lie. I found it, bro. No, I'm just joking. I'm just joking. But dark pools is good to watch, actually. And combine it with structure, ICT, whatever you want to do. But the most important thing is data, right? It's collecting, it's having a systematic approach. It's having like a step-by-step process of doing things. And more or less having data suggesting that the step-by-step things you're doing is profitable. Like, don't change the things. You should have step-by-step. Just 2 concepts, 3 concepts you're looking at. Specifically for me, it's externals. It's external alignment and it's time-based liquidity, engineer liquidity. Now I know those 2 things are profitable for me, and so I'm keeping that, alright? And that's literally my motto, right? Like I said, that's like literally my motto. That's how I trade, and that's how I trade profitably. Now, data that suggests it's profitable, but have 2 concepts and just trade out. Alright, you can trade real imbalances, you can do whatever you want to do. Any more questions? Otherwise, I think this is a rounded up call now. I think I'll round up. I've had literally calls for 6 hours now. That's crazy, actually. But I can go through another thing if you guys would like to. But I'll provide you guys with quite much gold, please. Okay. So yet again on gold, I'm actually bearish. I'm watching lower gold. So I'm actually bearish on gold. I want to lower gold here for a couple of days, potentially down in here, or potentially for the sell side liquidity here. That's just all I can say. So I'm bearish on gold. I'm gonna talk about specifics, but I think it's gonna go down lower, and I think it's gonna either consolidate or go down lower. So it depends. Like, it could go up higher, but I think it's gonna go down lower for now, at least. And if you're wondering why, I think that CPI is gonna go lower. Alright? And if CPI goes lower, gold will go lower. If CPI goes higher, gold will go higher. Because gold protects you from inflation. If you have low inflation, that means slow growth, and it means lower gold. Because gold is a safe haven asset in terms of inflation. Hopefully that makes sense, guys. Hopefully that makes sense. But yeah, any more questions, guys? Let's see if anybody have any more questions. Otherwise, I think I'll round this call off, and I think I'll call it a day. I think I provided. Hopefully, did you what do you think about this call? Did you guys like it, or did you think it was a stupid call? Thank you so much, bro. Thank you. Thank you so much. Perfect, guys. Thank you so much. Thank you so much. Really appreciate it. Really appreciate it. And I'm gonna focus so much on you guys, so don't worry about it. For anybody, alright, for anybody here having any questions, alright, please guys, DM me, alright, or at me in the chat. I'm always gonna help you guys. I'm always gonna try to provide as much context and as much information and provide you from provide you with my experience, alright, which I personally have, and trying to implement it and trying to help you guys with it. So if you have any questions, just please let me know. I'll try to answer them as to the best extent as possible. Now, of course, everybody has some limitations. I'm also a human, so you have to listen to me to an extent. You have to learn to listen to me to an extent, and that's also something you need to learn in life. To always listen to everybody. That's very good, very, very good thing to do. Always listen to everybody. Anybody having a different different mindset than you, having a different opinion than you, etc., etc. Listen to the different opinions, but always learn to take your opinion, or not like your specific opinion, but always learn to listen to yourself first. But you can still listen to other, but listen to them to an extent. All right, because you're the person which is most important. All right, you have chosen the things, you have overall done the things, you put in the work, and that's why, like, specifically the concepts you're focused on now, stick to those concepts, but you can still listen to me to some extent. But you need to remember that all of this is just to a certain extent, and also just from my perspective.